Chapter 8 provides an overview of flexible budgets and performance analysis. It builds on our material from Chapter 7 in budgeting. If you recall, in Chapter 7, in our budgeting process, we prepared a master budget. And our master budget started with a projected level of sales. And that level of sales informed our production budget. And based on our production budget, we knew how much direct materials we needed to buy, how much direct labor we wanted to purchase. We could put together a manufacturing overhead budget. All of these things also fed then into our cash budget and a budgeted income statement and a budgeted balance sheet. This chapter is going to look a little bit more closely at our budgeted income statement. We want to evaluate our planned performance with actual results. Recall, our budgeted income statement was based on a level of activity or a level of budgeted sales. In the case of the Royal Company, we had expected to sell 100,000 units in the second quarter of the year. Had we anticipated selling more units, we would have needed to acquire more direct materials. We would have needed to plan to purchase or acquire additional direct labor, perhaps purchase additional fixed assets. Certainly we would have incurred more in selling and administrative expenses. We would have had higher revenues. If we had planned on selling fewer units, all of those costs, direct materials, labor, selling and administrative costs, would have been lower than our final planning budget, as would have been our revenue. So in this chapter, what we're going to want to do is look at our budgeted income statement, the one we would have prepared back in Chapter 7, and evaluate it compared to our actual performance. So again, in Chapter 7, we talked about budgeting from a planning and control perspective. From a planning perspective, in other words, developing objectives and preparing some of our sub-ledgers and sub-budgets in terms of telling us what we would need to acquire in terms of resources to accomplish our goals, and to make sure that management had the plans in place to achieve those goals. Where in this chapter, in Chapter 8, we're going to use that budget, that planning budget, and we're going to compare it with our actual performance to obtain some feedback about how we are doing from an operational perspective. In Chapter 8, we're going to be looking particularly overall at our planned or budgeted income statement versus actual results. In Chapter 9, we'll look at more detailed variances with respect to direct materials, direct labor, and our manufacturing overhead from a production or operations perspective. So moving on, when we calculate or compare our planned performance with actual performance, the difference between the two is referred to as a variance. And we're going to find variances can arise from a number of different reasons. But the important thing to remember is a variance is simply the difference between two numbers, in this case our planned performance and our actual performance. Let's look at an example. Let's look at Larry's lawn service. We've got two columns here. We've got a planning budget where we had planned to cut 500 lawns during a month or year. We expected to generate revenues of $35,000, have expenses of $32,000, leaving us with net income of $3,000. Our actual results weren't quite as good. Our net income was less than we had expected. It was only $1,000, and we can see why. Because we had only cut 400 lawns. That resulted in lower revenues and lower expenses. If we focus in first on the difference between our planned expenses of $32,000 and our actual expenses of $29,000, we see we have a $3,000 variance. And our first inclination might be to celebrate that this is good news, that our actual expenses were less than we had expected. But a little common sense would point us to that difference in activity levels. We can see that we only cut 400 lawns where we had expected to cut 500 lawns. So right off, we would expect to have lower expenses. We would certainly expect to incur less in terms of direct labor cost. We would expect to incur less money on spending on gasoline and oil for our mowers. So we need to look a little further at what might have caused that variance, and we're going to do that in just a bit. But first, let's look at the rest of our variances. We have a revenue variance of $5,000. And again, that's simply the difference between our actual results and our planned results. And again, our variance with net income is $2,000. If we were to discuss these a little bit further, we might put a label on them and talk about them as being favorable or unfavorable. And when we talk about a variance being favorable or unfavorable, we're talking about how does it impact our bottom line net income. Since our revenues were $5,000 less than we had expected, this will decrease our net income, and we would identify that as an unfavorable variance. Expenses were $3,000 less than we had anticipated. Lower expenses, everything else being equal, would increase our net income. So we're going to talk about that as being a favorable variance. And then, of course, net income being lower than expected or anticipated would be an unfavorable variance. But as we mentioned just a second ago, we want to know a little bit more. How much of this variance was due to the fact that our number of lawns we cut was fewer than we had originally anticipated? We actually only cut 400, where at the beginning of the year we expected to cut 500. Or how much of these variances were due to differences in our selling price, what we charged customers to cut their lawns, and some of our cost, what we paid our employees, what we paid for gasoline, and some of the other items we spent money on. Let's look at that a little bit further. In fact, we're going to find we can break our variances down into two pieces. An activity variance, that would have been the difference between 400 lawns and 500 lawns, and a revenue or spending variance. Again, the revenue variance being due to charging our customers a higher or lower price than we had expected, and a spending variance arising from spending more or less than we had anticipated on a per unit or in total. To break this down and look a little further, we're going to need to prepare what's called a flexible budget. A flexible budget shows what our costs should have been at an actual level of activity. In other words, it's going to be a budget based on 400 lawns instead of 500 lawns. This will enable us to make an apples-to-apples cost comparison and an apples-to-apples revenue comparison. We can prepare a flexible budget for any level of activity within our relevant range. The reason I mention relevant range is our flexible budget is going to be based on that breakdown of costs into two types, fixed and variable. Recall, fixed costs remain unchanged within our relevant range, where variable costs change direct proportion to the level of activity that we engage in. So we're going to look a little bit further once we start the individual chapter lectures at how we prepare a flexible budget. But let's move on right now and look at how we might make use of a flexible budget. The first thing we're going to do is, instead of comparing our planning budget with our actual results, we're going to separate the two. And in between them, we're going to insert a flexible budget. Now, that flexible budget is a budget that's based on our actual level of activities. In other words, what would we have anticipated to earn in total revenues if we cut 400 lawns? And what would we have anticipated to incur in total expenses if we cut 400 lawns? Once we've installed our flexible budget in between our planning and our actual results, we can break our variance down into two components, an activity variance and a spending or revenue variance. Let's take a look first at our activity variance. Our activity variance is going to be found by comparing our original planning budget, which was based on 500 lawns, with our flexible budget, the budget we would have put together if we had anticipated only cutting 400 lawns. And in putting together this budget, we can calculate variances. And we can see that at this lower level of activity, we would have expected $4,000 less in revenues. So the $4,000 will be an unfavorable variance. But we would have also anticipated $2,000 less in expenses. So this $2,000 difference will be a $2,000 favorable variance. Overall, our net operating income is $2,000 less than we had expected, which means overall our activity variance was unfavorable by $2,000. If we compare our flexible budget with our actual results, again, the flexible budget being the budget we would have put together based on cutting 400 lawns, we can see that our revenues were still $1,000 less than expected, which is unfavorable, but our expenses were $1,000 less than expected too, which would have been favorable. Those two variances offset each other, and overall we see no net variance for net income. So again, our total variance can be broken down into two parts, our activity variance and our revenue or spending variance. In the case of Larry's lawn service, the $5,000 unfavorable revenue variance had two components. $4,000 of it was due to a lower level of activity. We just cut fewer lawns than we had anticipated. $1,000 of it was due to pricing our jobs to our customers at lower than we had expected. The two variances combined to give us our $5,000 overall unfavorable revenue variance. Our expense variance was broken down into two parts. $2,000 of our savings was simply due to lower activity levels than we had expected. We only cut 400 lawns versus the 500 we had anticipated. But $1,000 of it was due to better cost control. We actually spent less on the items that we acquired. Overall, in terms of net income, our $2,000 unfavorable variance is coming purely from a lower level of activity. So again, we can obtain feedback or information about operations by comparing our planned performance with actual performance.